All right, all right. TGIF. Good morning, everybody. We're going to get the PCE this morning. Remember, the Fed has adjusted their mandate. They're no longer focused on inflation because they slayed the beast, so they say. And now it's all about employment numbers. This is something you're going to want to pay particular attention to going forward. But anything that can affect the dot plot or get in the way of their new mandate and the market's anticipation of the cuts is something that you're going to want to watch. You can always go to CME Group Fed Watch. This is a free website. It doesn't cost you anything. And you can go in and you can see where the different FOMC dates are at and what the projections are from the market participants. If they believe that there's going to be a cut, how much that cut is going to be, how many cuts we're expecting to get, and how often it changes between where we were a month ago, where we were a week ago, or yesterday, or now. So if you hear people talking about, oh, they priced in that rate cut, they're pricing in holding here, and you're trying to figure out what does that mean and how do they know? This is what they mean, and this is how they know. The market's pricing in a lot of cuts. One of the worries is that the market is getting ahead of itself and they're going to be a little disappointed if they don't get the cuts that they want. The November 7 FOMC lines up with the elections and it lines up with QRA. That's going to be three very large things all landing in the front week of November. So with everything that you're swinging and holding and the trades that you're taking, just keep that in mind. November is getting close fast. I know it may seem like a long ways off, but this quarter is almost over, right? We're going to be into the new quarter next week, and November's just right around the corner. So looking at things that's happened around the world, Japan down 4.25%. I did mention yesterday, watch out. We had data coming out of Japan. It very likely could affect the market. There you go. NASDAQ is basically flat with the S&P and the Dow, and the Russell is up 0.25%. It shows that we're waiting on this data and that the data may be impactful. Market Watch is usually the website we go to that has the least amount showing on it. They only focus on US markets and they only list the things that they deem to be the highest impact event. So normally it's 2, maybe 3 spots that you see when we go to Market Watch. But as you can see today, it's a very large list at 8:30, just a significant amount of data coming in this morning. Look at the economic calendar from FX Street. This one at least has the impact meter so that if you're trying to learn which economic event has history of moving the market, this is a good way to go. It's not perfect. It's not going to tell you if it will move the market. It's only telling you what it has done in the past. One of the things that I notice it gets wrong is it says the auctions are always low impact. And they don't really seem to mind which auction it is, whether it's, something that fits in the IRX in the front end, 13 weeks, 2 year, 5-year, or if it's some of the bigger 10, 20, 50 or 10, 20, 30, they just don't seem to care. I do. I think it should be at least orange, if not red, but whatever. When you see an auction in there, pay particular attention. The market was moved yesterday by semiconductors to the upside, and then SMCI took us to the downside before we started to decouple and try to rebound off of that. Still, you want to keep your eyes on semis as a group. I know everybody tends to just focus on NVIDIA, but collectively, keep your eye on semis. So we got a fairly tight range in the overnight today. Since we're basically flat, we don't have any edge for one side or the other. If we do make a move to the lower ADR, it will line up with Wednesday's low, but a move to the upside to hit the higher ADR would mean that we had an inside day breakout on the week, I believe. Have we gone higher than that? Nope. It'd be a new high on the week. They are hedging this morning. That kind of shows the significance of how big today's data could be. The central pivot range for the second day in a row has a very narrow channel. This implies that if we break out, the breakout could stick, that we could actually go somewhere. Just remember, these channels don't make price breakout. It's just giving us some guidance on if we do break out, then what? The distance set by the floor pivot this week, we could exceed that with the inside week breakout, getting through 58.32 cog line and expanding to the upside. But when we got near 58.32 last time, which was yesterday, we weren't even able to get there. They took a front run on it. We had a smackdown at that point. We're still considered bullish if we're above this weekly pivot. But as I've mentioned before, that's just a very generic concept, because if you're 4.5% away and you fall towards that pivot all day long, you can't still say, well, we're above the weekly pivot, so I guess we're bullish. Not if we're falling all day. If we were to take that perspective out onto the higher time frames, the hourly, daily, weekly, if we're still above that pivot when we close at the end of the week, then we're still doing well in the bigger picture. I wouldn't necessarily say we're bullish, because that implies that we're actually, moving higher. But if we're closing above it on the week, then we're maintaining that bullish posture at the very least. Now that we've pulled back some, we're getting tangled up into the volume profile. Our own profile on the week has 5780 as the point of control. Kind of tagged that last night, or yesterday, I should say. Yeah, yesterday. So it's still the structure that we want to focus on. A downside move putting us down into that 5780. We would expect it to hold, see what we can get out of it. If we get underneath it, that will become a trap that we'll have to fight to get back through again. And it's a relatively large zone. It expands into last week's range where we had that double D. So it's still the same thing. If we break below 5750, then we can drop down into 56.92 cog line, relatively easy cut through that, and you're looking at 5500. It sounds pretty extreme when we're sitting at 58, but this is a weekly perspective, not an intraday. So we're not talking about making that whole move in one shot. The AM Founders Note came out right before I started. That's why I was a few minutes late getting started this morning. So I haven't had a chance to read it yet. Likely you guys are reading it before me. So you're going to have a better idea about the levels. I just caught as far as the AM core PCE, no one cares. That's their take. And they're saying that based on the SPX 0-day at the money straddle, which is very small, and it has a very low IV of 16.8. That's as low as it gets, reflecting traders' bets that today is rather boring. That's what they say. I say if it's so boring and no one cares, why are they hedging? That's my take. They must be worried. Otherwise, they wouldn't be hedging. Hedging is cost. You don't set money on fire and throw it into the garbage. Volume is sitting at 85. That's a pretty good volume level uh, within normal ranges. If it was too low, say below 50, or if it was too high, something like 120 to 150, then we'd be a little more concerned. But 80 is kind of the sweet spot. So nothing wrong with that. With the range that we set yesterday, it's very likely that we hold the line into the close and we finish off the week just right here, right where we are. It's worth considering what that would look like. So every day I try to help people prepare for the intraday and get ready to trade with pivots, levels, structure. But a lot of times those levels will not do you any justice if you don't have any bias behind it. That you have an expectation before we even get into the regular trading session. Is today supposed to be a bullish day or a bearish day? Are we supposed to break out and run today, or are we supposed to hold the line? The base case today is we're supposed to hold the line, that we'll go into the close, maintaining this move on the week. And with yesterday's really wide day, that gives us a range to focus on. With the profile and everything else that we looked at, we could adjust that range a little bit more and bring in Wednesday's low with Thursday's high. And that's pretty much your week right there. Base case argument for today is that we stay inside this box, 57.70 to 58.30. It's a 60-point range. We're not asking for much here, but it's a good size range for the day. We could do a lot with that. So that's the bias. If we get to the edges with 58.30 and 58.32 cog line, the expectation is that we should be expecting a reversal here. I'm not telling you to put an order on the dome to take a short as soon as it gets there. Just that our expectations are we're not going to break out and continue to run higher and higher and higher. The thing is, you do have to consider what coming back up to the top would be. That would form either a cup with a handle, or it would form a double top bull trap and we would go down. One of those two, all right? So then it leads us to, well, which one should we prepare for? When we get back to this previous range, if we stop right on the line and we start to fall, that to me sets us up for the cup. We stop right at the previous level. We pull back to not necessarily a half. I like to say a third, but fractions tend to screw people up. We want to pull back about a third and then run up and break. That would be a perfect scenario for a cup and handle. The double top bull trap, on the other hand, we want it to go further than the previous pivot point because we got to get the bulls engaged, right? We got to trick them into actually getting in. And if we stop equal to the previous high, we're not tricking any bulls, right? So we need it to break out and expand farther first so that we can trap them and dump them. So we need to measure this zone up here and identify, because there's also a third option that we just come around and we go and we break and we just run and we don't stop, we don't pause, we don't pull back. That would just be a cup with no handle. We could do that too. So if we break out, how far above this previous high do we have to go before we say it's not a double top with a bull trap, but it's actually just a breakout and we're running? To me, the 111 and the 1236 is a really good representation of that zone. Liquidity resides on the other side of the pivot. It's a phrase that I use all the time, trying to remind people that this is where there's going to be a lot of traders. There's going to be a lot of trades there. That's the expectation. But we can assume that, and then we can prove that. When price starts running up and gets near this level, we want to look at the dome and see where the active trades are. Is there a lot of liquidity at this level? A lot of orders on the dome. Now, if you're running top of book, you can't see it. You got to get full book. If you're buying your data and you're on, Trade of 8, Ninja, whatever, you need full book. You do have Bookmap. I use Jigsaw. Doesn't really matter. You do have those advanced order flows, but you want to see that. If you don't have any of those tools and you only have top of book, then at least just prepare for the idea that if we break out and we're still in this zone, that it could still be a bull trap. That zone, even though I only highlighted the lower section, it really does expand all the way up to here. The heaviest concentration of that liquidity is going to be in the lower portion, but the whole thing is where we expect liquidity. If we get through that, then we're looking at a breakout that has legs, and we can start to focus on 1.5, 2.0, and these higher levels. But we have to get through this first. Base case argument today is we're going to hold the line and we're not going to break out and expand. So if we get into this zone, we're expecting a reversal. Same thing can be said to the bottom side as well. We're not expecting to break out and run. So if we break yesterday's low, it'll give us the liquidity zone into Wednesday's low. And if I drew the fib just like I did a moment ago, we would have the 1236 and the 111 down here. Liquidity resides on the other side of the pivot, and we would expect price to come back in. All of that is predicated on today's data not being impactful enough to send us out of the box. Yesterday, we had a lot of big data that normally would have been violent, and the market shrugged it off. It didn't care at all. One of the reasons it shrugged it off is because the numbers were in line. They were what they were supposed to be. And when you get the data that you're expecting to get, well, you're already prepared for it. It's what you were expecting. The danger is, what if we get some numbers that are outside of the consensus estimate this morning? And we get a little bit of shock and awe. Like the founder's note said, who cares? The volatility is showing that nobody cares. Well, the hedging suggests maybe somebody's a little worried. If they're worried and they're wrong, and we end up on the wrong side of those numbers, then the levels that I gave are not going to stick. Nothing would stick, right? No pivot point, no structure. We'll get a big move, and the market will have to deal with it. So my base case is that we hold the line, the news won't be impactful, and we go into the weekend within this range from Wednesday's low to Thursday's high. If I'm wrong, then the alternate thesis is in play that we get past the 1236 and we target the 1.5, either because of the upside breakout or the downside breakout. Now I get it. That's a really wide range, and you probably are going to want to trade, like me too, inside of this, because, well, we're not going to sit around waiting all week for it to break out. So you can do the same thing on a smaller scale right there. There's your 111. There is your 1236. That is the liquidity on the other side of the pivot. And if we can get through that, then we can expand further into the 1.5 and on and on. All right, same thing, just repeats over and over and over again. $10-day, 30-minute volume profile. We have no change to the point of control. We're not expecting any change anytime soon. We're not building up structure across that high at that 86.32 cog line area. We're not building it up there enough at all. The only thing that could challenge this zone would be this lower zone, and we're going to lose that lower zone before we lose the upper one. So we're looking at least a week and a half, 2 weeks, with this being our profile and with this being the point of control. No VPOC from yesterday. I kind of thought we would have a chance to keep it across that high yesterday, and we were building it out pretty good in the pre-market, but we got a significant amount of volume in the later part of the day. That became our point of control. Then we ran through it, so no new VPOC. We do have a really nice cluster this morning. This is a compact D-shape profile. It is today's though, so it has limited scope. But if you're looking to work more on your profile analysis, then you want to save really good examples, right? If at the end of the day this is our really tight range, that would be a good example to keep. We do have next week's weekly expected move, but it's not set yet. The gray line is our current price. As the ES moves up and down, all three lines are going to move with it until we get into the close and past that to 415. After 415 today, this will be locked into place, just like all these others are locked into place, and we will have next week's range. But like we do every Friday, we measure the week that we just had and we lay it on top of next week's, and we get a feel for what are they doing with volatility next week. Are they projecting more or less volatility? The range here, the size of the box, is based on time and volatility. If the time didn't change, meaning we had 5 days this week, we have 5 days next week, so we have the same amount of time, then the only change to the box being larger or smaller would be volatility. If the box is smaller, volatility is less. If the box is bigger, then volatility is greater. We can see that at the moment, the lines or this week's upcoming box is smaller than the current week's box, implying that there's less volatility being priced into the market next week. That makes sense on one hand because we got all of the volatility events this week. I haven't caught yet whether the president signed the funding that should get us into December, but the government shutdown, last I knew, had been averted because he needs to sign it. But honestly, I had a really busy afternoon and I just don't know if he got it signed yet. I don't see any reason that he wouldn't have signed it, right? So probably did. And that kicked the can a few months down the road, which is better than a few weeks. I was concerned that we would get that like 2-week little bump and then we would be right back at it again and it would be looming on us as we got into November. But nope, that at least gets us onto the other side of that November package where we got QRA, FOMC, and the elections all up in that front week. We're less than 1% above the 10-day, working our way back down in a gradual decline, which is fine. As long as we're maintaining above the 10-day, then we're still in that bullish posture and we're not overbought. We're not overextended. It doesn't owe us a pullback. And we're more than 3% above the 10-week, which is fine, kind of holding the range here. It sounds extreme, but if you look, we've been higher than this before. We just don't usually stay at that level. One reason being that if we stop moving higher, the 10 won't, and so it'll come and catch up with us. The other reason being that we could pull back a little bit. So we are in the sweet spot. Anything above 2, maybe 2.5, that's good, right? All through here. Once we start getting above, say, 4, then we're getting into some extremes. So really don't want to see it up there because then we are going to be looking for a bit of a reversal. China ADRs are up again, along with Bitcoin. And really, I mean, that's what we got, right? The Bitcoin and the KWeb constituents. That's it. The Mag 7 down flows are up this morning. I know that sounds confusing. There's an FNG, which is the fangs. There's an FNG up and there's an FNG down. If the Mag 7 is doing good, then the FNG down is down, right? It's negative because it will only be in the green if the Mag 7 are not doing well today. If the Mag 7 are doing well, then we would see FNGU being green, and it's not. So there's some issue with the Mag 7 this morning as well. This is TradingView's heat map. I have it set to pre-market, and then I ran the filter because I can only look at the S&P 500. I can't look at the S&P 100. So I set the filter to market cap, and I narrowed it down to 89 stocks. It's close enough to 100 for my taste, because really we just want to see what the top 50 or so names in the S&P are doing. The size of the boxes indicate their market cap. So the Mag 7 stand out really well. Amazon, Nvidia, Apple, Microsoft, Meta, Google, Tesla, for an example, right? They're just really easy to see. We do have some that are negative, like Broadcom and NVIDIA. But on the other side of that, Google and Apple are both up. Meta and Microsoft are flat. Tesla's down 1%. So it's a mixed bag with the Mag 7 this morning. It's not as cut and dried as just saying, oh, well, they're down. Some of them are down, definitely, but a lot of them are flat. And so the ones that are down, since we have a lot that are flat, we have more that are down than up. And the flat ones aren't tipping the scale in one direction or another. That's a nice move in Tesla again this morning. Likely it's not done yet. I'll be working on rebuilding the scale that we used to use. I quit doing it after they made a bunch of changes to their scanner. But if we look at how many names in the pre-market are up versus how many are down, then we have breadth before we even get the day started, right? Looking at that pre-market breadth. If you got 95 names out of 100 that are up in the pre-market or down in the pre-market, then you have a much better sense of things than just what the sectors provide, right? And don't get me wrong, I like knowing what sectors are up or down in the pre-market. But having that greater insight of what names are up or down, that goes a long ways. So I'll get that rebuilt. We'll very likely be doing that, going forward in next week's morning briefing. So a pullback in semiconductors, SMH, NVIDIA, go on down the list. Gold miners, we've had a pretty good run, so it makes sense to see them take a pause, call timeout. We got pot stocks, China ADR, Bitcoin, crude. That makes sense. Crude's been on a beat down. So, getting a little bit of a flip there. A little mean reversion makes sense. Energy, another one. It's been taking a beat down, trying to turn around a little. So we got most of the market not doing anything, waiting on data. As Spot Gamma says, because nobody cares, right? Nobody's worried about PCE. Yeah, I disagree. If nobody cared, we would be up more or we would be down more. They're waiting on data. They wouldn't hedge if they weren't worried. So watch the clock. Got a lot of data coming in. Keep in mind that we have the potential for a liquidity gap like we talked about yesterday. We could get it today. That 8:30 time frame is going to have a lot of data packed into it, and it only takes one of those to surprise. The base case, if the news is much like yesterday's and everything is in line and the market shrugs it off and everybody's happy, then you have your range. You can also stack it one at a time. First, answer that question. Are we still within our own Globex range? So once 9:30 comes and we're in the regular trading hours, look left. If we're still inside of our own Globex range, then we're not trending. We haven't broke out. We're not going anywhere. You get out of that range, then you can ask the question, are we still inside yesterday's range? Then if we are, we haven't broke out. We're not trending. We're not going anywhere. If we break that zone to the downside, then are we still within Wednesday's range? An inside day breakout would start by getting outside of Thursday's zone. Then we can test Wednesdays and test Tuesdays. Everybody, be careful, be safe, enjoy your weekend. I'll see you all next week.